For more on the markets, let's talk about something interesting. For more on the markets and what options are saying about equities, let's bring in Amy Wu Silverman, head of derivative strategy at RBC Capital Markets. And it wasn't so long ago we had you on. It was before the election, though. And at the time, you noted that something wicked this way was coming in terms of volatility. And as you point out, it didn't last the entire day. The volatility and the premium and all the risk trades came out very quickly. About what time that day? The markets knew it wasn't going to be a protracted thing, and that's what they were worried about. You think they were looking at the betting markets? The options markets are all in tandem?
Perhaps. I mean, I think one thing we learned from this exercise, at least, is relative to polling markets, the derivative markets were far more accurate. And one thing we wrote about was when you actually look at the vol crush, so meaning there's a huge volatility premium that comes in when there's any sort of event. Obviously, a U.S. election is a major event. That volatility crush started to suck in prior to polls even closing. We saw, trades you would call Trump trades. We measured them in thematic baskets, all rallying prior to that day even being over. And so what I thought was very interesting about that is, in some ways, when you think about signals going forward, the derivatives market, these thematic markets, were really much more accurate than I think what the polls were telling you that day, which was that it would still continue to be very close.
I wonder if, like, poly market and the betting markets were following that data, or whether that data was following the betting markets, or both. I think it's all a manifestation of the same thing. Investors knowing, when you got money on the line, it's a lot more than answering someone's phone and either lying or whatever make the polls so useless.
Well, I think one thing that's interesting, and you guys have talked about this too, but there was sort of a whale in one of the betting markets, right. And that person is anonymous. But one thing they said was they've sort of taken a look at this much more agnostically from like a statistical perspective and tried to model out that volatility. And if I had to hazard a guess, this is probably someone who traffics in derivatives, because when you think about it, it's just really getting specific measures of that probability. And that's a very apolitical statement. It's thinking about the proper way to measure those tails, which sometimes I call fat tails or right tails or left tails. But getting that down to a very accurate level is something that derivatives traders try to do all day long. I
don't know what the odds were, but it was like $27 million. And I said at the time, I'd love to make $27 million if I could make I think I had a much better feel for the election than last night's game, although I did have Miami. But it's a lot easier to pick that. If you can double your money on something like that, why not do it? But you're not doing it for fun. Some of the other stuff that is the Trump trade finished. You think maybe not, because so many long hedge funds didn't take a position, and they were going to wait till after the election to play these things.
Yes. So what I have said is when you kind of look at different cohorts, so meaning the hedge funds or the long onlys, when we've had conversations, and this is anecdotally, but you see it in the data too, a lot of long onlys were actually saying we're just waiting for this event to be over. We're not going to deploy any capital until it is over. It's sort of a wall of worry you have to climb. Some people were pre-positioned, some people weren't. And one thing that tells me, because we have seen this play before, because we saw this during the kind of FOMO momentum you saw during when people needed to get into the AI rally earlier this year, those similar sentiments in the derivatives market look very similar to what that was the first half of the year, meaning you saw this bid to call buying that hasn't gone away in IWM, that hasn't gone away in what you would argue are the Trump sectors. So even though we might have a near-term flagging, that's still the headwind, the tailwind that's behind you. And then after that, you also just have seasonality from November. It tends to be a time where volatility is very muted, and it tends to be a time where the market rallies anyway.
So what are if you wanted to play it from here and try and piggyback with this money, this smart money, what would you do? What would you be long? What would you be short?
Yeah, so we do it in different ways. I think the one that is most obvious right now is IWM. And when you look at the call wing of that IWM, people continue to buy that right tail. And so things that leverage off that similar trade would be IWM call spreads. Now, outside of that, we have a lot of thematic baskets we talk about, which are just, if you simply look back to 2016, there are these beta sensitivity playbooks that you would call Trump trades. You know, they might be old economy trades. They might be trades that are more heavily skewed to deregulations of certain financials. KRE is a good example of an ETF proxy that would play that. But those have done very well. We've seen multi-standard deviation moves. But again, when you see that FOMO momentum in the derivatives market, it often means that momentum will continue, not that it will flag.
Russell's going to keep going then, you think?
Yeah, and we continue to see that in our skew data. So it doesn't mean there might not be near-term flags, but when you see that, it continues for a while.